Welcome back to my channel. Today I'm back with another video. In this one, I explain the differences between supply and demand, support or resistance, and order blocks, and how smart money uses them in the market. These are completely different tools that every trader should understand. Okay, let's start with order blocks. In a smart money concepts, an order block is the last candle before a strong move that creates an imbalance in the market. It represents the area where big institutional traders are likely placing their orders. An order block can form at the beginning of a strong move or sometimes in the middle of a move. It can be a candle in the same direction as the move or even the opposite color. But what makes an order block a valid order block? There are three key things you need to look for. A valid order block creates imbalance or inefficiency. Price must move away strongly and quickly from the candle. This is called displacement candle. You'll notice little to no overlap between candles. It shows a strong momentum from institutional activities. In smart money, they usually call it fair value gap. The next key point is it and a valid order block breaks market structure. The move from the order block must break a previous high or low. This confirms the move is meaningful because it caused break of structure, and it also shows a shift in market direction or a strength. And the last key point is a valid order block should remain unmitigated. A valid order block is usually traded only on a first return. Price has not yet come back to the zone. Once price taps the zone and reacts, it is considered mitigated. And after that, it often loses its strength. Let's take a look at a real example of a valid bullish order block. As you can see, price made a strong impulsive move upward, leaving a clear gap between candles wick. This gap, called imbalance, inefficiency, or fair value gap, it shows that smart money entered the market aggressively, pushing price up so quickly that not all their orders were filled. Because of this gap, uh, this order block becomes a high probability zone where institutions may return to fill those leftover orders. At the same time, you can see this move cause a break of a structure. So it break the last protected high and break above and close above the previous swing high. This confirms that buyers are in control and that the market is likely to continue higher. After the impulsive move, price retraced back to the origin of the move. And as you can see, this retracement is not sharp, it's just very smooth and slow. And specifically, most of the time, it traces back to the last candle before the breakout. This is where the order block is located here, and price returns to mitigate that zone. In this example, all three conditions, all three key points that we discussed in a previous slide are present: inefficiency or gap, a break of structure, and unmitigated zone. Okay, now let's talk about supply and demand zones. S&D zones are areas on the chart where buyers or sellers step in with strong momentum. Demand zones push prices higher, supply zone push prices lower. These zones usually form after a strong rally or sharp drop, where large institutions enter or exit positions. This surge of orders often causes price to reverse direction. Because of this, supply and demand zones act as a key reaction areas and can help you find high probability trade setups. There are three main criteria for identifying valid high quality S&D zones. First, look at the candle size. If you see large, clean candles moving strongly in the same direction, it often indicates a strong institutional activities. Second, you have to focus on fresh, untouched zones that price has not returned to yet. Zones that have uh, already been tested tend to weaker because of many of the orders have already been filled, which significantly lower the probability of a strong reaction. Third, a high probability supply and demand zone usually breaks a key level, such as previous swing high or swing low. This shows that the move had enough strength to shift the market structure. Okay, let's look at an example. Here we have a strong, powerful candles, red candles, moving in a clear down direction with very few wicks. This indicates that large players enter the market with significant volume, and as you can see, the volume is pretty high. The zone is also fresh and untouched, which increases its reliabilities. Price then breaks a key level, dropping below a previous support or swing low and printing a new low. This confirms a strong selling pressure. All of these factors make this a high probability supply zone that deserves a serious attention. So remember, an order block must contain a fair value gap and remain unmitigated. The fair value gap is a sign of a strong, aggressive institutional activities that create imbalances. It shows the price moved so fast that not all orders were filled. Without this imbalance or inefficiency, the level is not a valid order block. On the other hand, supply and demand zones are more flexible. They don't always have a fair value gap. They can be mitigated, meaning price can return to the zone more than once. This is one of the key differences between these two concepts. Order blocks must have a fair value gap and they must remain unmitigated. Without the clear institutional imbalance, the level cannot be considered a true order block. Supply and demand zones, however, may or may not have a fair value gap. They can also be mitigated and still remains valid, but with every touch, it loses its strength. Okay, now let's move on to the support and resistance zones. Concepts that many traders often confuse it with supply and demand zones. Support and resistance are price levels where the market has reacted strongly in the past, either rejecting the level or reversing direction. However, just because price reacted there before doesn't guarantee it will react the same way next time, again and again, although it often does. When price returns to these levels, they tend to act as a key decision points areas where it can build liquidities around those areas. It can be a traps for retail traders, and it can be a level that smart money may step in. That's why they call it key decision point. To mark high probability S and R levels, means support and resistance, we have to focus on few key factors. We always start with the most recent market extremes as they are the most relevant. Second, we watch for multiple rejections. The more times price reacts to and rejects the same level, the more attention it gets from traders. Here, for example, we created a support. We formed here a support zone, a support level, and as you can see, the price touches this level multiple times. Those red circles. because this increases the chances of reaction. And lastly, the best levels are the ones that are easy to spot on the chart. So if you open the chart on any time frame and you easily spot a level of resistance or level of support, that's it. If it looks obvious, chances are many traders are watching it. Support and resistance zones can sometimes act like a magnet, pulling price back for a liquidity sweep or potential reversal. When marking these zones, always prioritize recent levels since older ones tend to lose relevance as market conditions change. Okay, guys, I hope this video helped you clearly understand the differences between order blocks, supply and demand zones, and support and resistance level. If you found this helpful, don't forget to like and subscribe to my channel. Thanks for watching, and I'll see you in the next video.